The main event for the markets this week is the inflation data at the consumer level. We get the CPI report for November. It's due out tomorrow morning, and it is expected to show that inflation ticked up slightly from October. You're talking up 0.3% for the estimates on this. Last month, it was 0.2%. You're also talking year over year up by 2.7% versus up by 2.6% for the previous month. For more on this right now, we want to bring in Eric Freedman. He is Chief Investment Officer of U.S. Bank Asset Management, which has nearly 496. I think it's just almost $500 billion in assets under management. And Eric, I want to welcome you here. Thank you for coming in today.
Yeah, great to be here. Absolutely.
So you do have a lot of money that you're managing.
We're happy to round up to 500. It depends on the day. But yeah, I would say it's a great client base, ultra high net worth, institutional, and also mass retail. So it's we see a lot of slices of life, and it's certainly fun to work with that many different client types.
What's the biggest concern you hear from your clients at this point?
Number one is inflation. I think that people are consistently saying, look, this is an environment where, as we kind of look at the sort of tail end of this year and into the start of next year, will we be able to sustain interest rates really below that magical 5% number? That's for the 10-year Treasury. Seems to be where the good things happen for capital markets. So we think that, again, still that risk-on perspective across a lot of different asset classes works. Inflation that pushes above, that 2.5% to 3% sustained level, that could be the elevated level, if you will. It keeps the interest rate bond vigilantes really still in play, and that push towards 5% could be more of a challenge for markets.
If your clients are worried about inflation, then they have to be worried about outpacing that inflation in their investments. What do you tell them?
Yeah, Becky, it's one of those things where it's been stubborn to get people out of cash. When you've had this almost nostalgic view of cash above 4.5%, that's sort of been a level that people have really anchored on, if you will. So we've been emphasizing a variety of different things. Again, everything from dividend-paying stocks to international equities, also a lot of private assets, which we think makes sense, but even things that aren't so expensive that don't necessarily roll off the tongue. So things like structured credit, which does provide a pretty solid total yield that isn't just susceptible to interest rate risk. Those are things that we really entice people to move out of cash into more productive assets.
That's an interesting point, though. All this cash that's sitting there waiting on the sidelines, part of that is people have been waiting for a pullback that they haven't gotten.
Yeah, it's been the sort of, the waiting for Godot, and Godot never shows up. And I think that, there are a couple of catalysts out there. Again, there's CPI data. We're in this lull period where we don't have a lot of corporate earnings. We're sort of waiting for more concrete policies from the new administration. So there may be some opportunities, some pockets to pick up. Clearly, in anything that hasn't been dollar-related, you've had lots of pullbacks. So the things that really haven't worked include, international equities, especially the European side. So for those that are looking for more of a valuation play, that's starting to become more interesting, but probably a little brave to step in before a lot of tariff releases emerge.
And that's what people say. Look, we have run so far over the last couple of years. Markets are up substantially. The PE ratio has gone up substantially on all of these things. And we're getting a lot of what you might anticipate coming from this new administration came from Election Day on. So you're seeing a front-end loading of some of these gains. And that's why people will say, maybe we want to be cautious, maybe we want to see what comes next. But if you also have all this cash that's been building up on the sidelines, I wonder if any slight pullback that begins 2, 3, 4, 5% gets washed out because that brings new money in too.
Yeah, I think it's a great thesis. I mean, this sort of wave we've been playing, it is like ex ante before the next wave of, we think, animal spirits and sort of more progressive policies come through. We've been overweight global equities, especially U.S. There's another leg to that trade, we think. But again, nothing solves high prices like high prices. And I think that enticement of getting people in, such a continued inflow, I should say, of assets into equities, particularly U.S. equities, that train just continues to roll. So we think there's still an opportunity to again, be aggressive, but there's probably another leg that has to be proved with a little more policy certainty. That's probably a good thing for us to focus in on.
And we started this conversation with you saying inflation is the biggest concern. Maybe that's the thing outside of geopolitical things that we can't control, don't know anything about. But if inflation were to rise again and be stronger than anticipated, and the Fed either had to stop cutting rates or start hiking rates as a result, maybe that's the game changer.
Yeah, agreed. That would be the sort of push, if you will. We haven't had interest rates in this country above 5% in 17 years. We had one day last year for like literally a millisecond, and since then we've obviously had some rate increases, and we've obviously had a bit of a pause from the Fed. But that move below 5%, which precedes the great financial crisis, that's really has been at least correlated with higher asset prices. So that's a test the markets don't want to see. We think we're in good shape if we stay below that 5%.
We used to do fine at 7 and 8% for years, and companies deployed cash and took risks, and things were allocated. It was fine, but it seems like those are a bygone era. And then I was just thinking about inflation and just how debilitating it really is. So it goes up 20% in 1 year, and you're like, oh my God, I can't afford any of this stuff. Then the next year it goes up another 3 on top of the 20. Then the next year it goes up another 3 on top of the 23. Then the next year it goes up another 3 on top of that 23. So now you're at 20. Nothing's solved.
That's right.
The rate of increase, has moderated, but you're still buying the things that you couldn't afford when it was up 20. And they're up 26.
That's right.
What it would take for deflation?
Well, I don't want deflation. I know, but we're in this. It's things you're still scanning those things, and you get done, and you're still like, holy crap! Things are different. Things cost a lot.
And it's
more.
also so unevenly distributed too. If you think about the impact on the balance sheet of a lower-income consumer, I mean, it is.
Think about that.
Yeah, it is both in terms of shelter costs as well as food, transportation. That's 60-70% of the
take home or whatever it is, and you go to the supermarket. And really, you spend $250, even when you're scrimping for a family of 4, and you're like, wow, what do I have left?
It's a big number. Yeah, and it's persistent. Absolutely.